Welcome to Current Yield, Grant's interest rate observer of the air. I am Jim Grant, and with me, unfailingly, is the gentleman to my right, the great deputy editor of Grant's, Evan Lorenz. Evan, that's you.
I hope so.
Yeah, and sitting immediately to my left is Seth Weissman, who's from the 14th floor.
Thanks for having me.
Oh, you're welcome. And I suppose we ought not to assume that everyone knows what the 14th floor signifies in this context. Well, the 14th floor is the 14th floor of 233 Broadway, the grand old Dowager Woolworth building in Lower Manhattan, nearby City Hall, where so many good things happen. And I'm not saying that we would not have had Seth Weissman, who was the founder and president of Urban Standard Capital, a fully integrated real estate private equity firm focused on debt and equity investments across the United States. I'm not saying that we would not have Seth on this program, except for the fact that he has his office in the same building as we do, but it doesn't hurt the commutation problem.
Yeah, I would definitely go more than 10 floors to visit you guys. So,
well, let me say, synchronously, we would have walked across the street to get you. Yeah. So the person who's laughing across the way is Harrison Woodell. He doesn't ordinarily run the sound engineering department of this organization, but he has proven that he can do anything. So why not, Harrison? Welcome. Yeah. So Evan, before we get started into Seth's line of work, tell me if I wasn't correct in my forecast that the next 4 years, I said this out loud, first week of November, I said the next 4 years are going to be good copy. Am I right? Am I wrong?
You're wrong. It's great copy.
Yeah, it's scarcely started.
The inauguration was just, as we're recording, a little over a week ago, and we've already gotten quite a lot of stories.
Yes. So we wrote about this week, ladies and gentlemen. I hope that many of you are subscribers to this publication, and for those of you not, I'll just give you a faintest little hint of what the issue of Grants dated January 31st leads with analysis and a contemplation of the significance of the Donald Trump rug pull of Friday, January 17th. That was the day of the issuance of the $ Trump, the Strump meme coin, which at one point, soon after its launch, went to, was it like 30 or $40 billion notional market cap?
I think it actually went to 60. Like when you look at the market cap on like coinmarketcap.com, it'll actually show a lower number than the total dilution. That's because they only show the market cap for the free float. But Trump owns 80% of the market cap that doesn't float. And the fully diluted market cap, I think, got up to like 60 billion. I think it's like 25 billion today.
Yeah. So I say rug pull. I don't know. That's probably not fair. But this was, I did some historical digging in this, Evan, and I was unsuccessful at finding a precedent for it. Now, the United States government has had a long history of investment promotion throughout the 19th century, or at intervals throughout the 19th century. It was in the business of selling public lands, sometimes on a considerable amount of leverage. And then comes the 20th century as time marches on, and it sold bonds to finance the First World War. And in so doing, selling these Liberty bonds, it educated an entire generation in fixed income investment. And so innocent were so many of these newbies that they kind of in a charming way showed up at the bank and asked, was it time for them to pay the government the interest that they owed on their bonds? Mm-hmm. So sweet. They weren't aware that the government was to pay them. So I guess the government should have made that disclosure in a slightly larger type. And then, the government's done all sorts of, and then I suppose by way of its laying its blessings on the 401k and IRA plans, it has given a tacit imprimatur to the 60-40 investment mix, I think, retirement mix. Yeah. Okay, but I think never before in the history of this country has an administration, or least of all the head, has at the head of an administration lent his only to an entirely speculative asset, a zero-sum game of no economic utility except for the fact that it would go up or go down. That is a first in the history of our country. That is an American first. I tried to think of which other president might have done it. George Washington? No. Let's see. John Adams? No. Honest Abe?
I've never heard of an Abe coin.
I think especially honest Abe would have thought twice about this. But it is an act of the consummate indiscretion and breaching. Something rang in the back of my mind. It was a recollection of an essay that appeared in the Atlantic Monthly. And of all the fraught months, all the portentous months, September of 1928, I think the stock market peaked maybe in August of 1929, like early August or early September. Anyways, a year before the top. And it was called Capiadors in Wall Street. Capiador being a participant in a bullfight who prods the bull and teases the bull and induces bullish behavior from that bull, just brings out the worst in this big animal. And the author tried to pull over the point. His name was Ralph Ward Roby. And Roby tried to put over the thesis that Calvin Coolidge and his Treasury Secretary, Secretary Mellon, who was about the richest man in America, were responsible for the speculative excesses of the late 1920s. And so you open this, you was hungry for the evidence, right? How did they do that? What did they say? And there was nothing. If you are a reader of Truth Social, there is no comparison. So now Calvin Coolidge famously was Silent Cal, and whenever he thought of saying something, he didn't say it. And I'm thinking that maybe Donald Trump studied that model of presidential conduct and decided to invert it, because there's nothing that he won't say, nothing he can't not say. And so anyway, so Roby put this thing. I said, what even made him think that Mellon and Coolidge were responsible for goading the American public into paying like 25 times earnings? Yeah, as opposed to sales. And once he quoted Calvin Coolidge saying that business conditions were satisfactory. That's unduly provocative, perhaps, yeah. And then again, once Andrew Mellon said something nice about, I sound like Trump, something nice. He said something constructive about the institution of easy money. And sometimes there's nothing not to like about that. And finally, the smoking gun was words attributed to Coolidge. Coolidge was said that he didn't think that margin loans were high enough to be a worrisome feature in the marketplace. That's it. Never did Coolidge say, Bitcoin is the new steel industry, or that this sucker's going straight to the moon. Nope, never said it. So we wind up reflecting over the past century that norms have changed. Thank you, Captain Obvious. That little did posterity imagine, and I don't know. So just getting back to the original point, Evan, this is at least it is great to write about. I mean, we can't. A newspaper guy cannot really resent what's going on.
No,
not professionally.
There is genuinely something new every day that you did not expect to happen in the news.
Or ever. Yeah. Well, Seth, this is an entirely non-political show, by the way. All I'm doing is saying that there was a singular event on January 17th, followed by another one on the... and there's a third meme coin issued by ministers of God who delivered one of the four benedictions. It was the one you will never forget. It was a quite flamboyant benediction, and his coin came at 2 cents and is now quoted at 0.0001, I think. So he never achieved a market cap higher than like $400,000, and now it's kind of like down. It's whatever 99% down is. That's what the market cap is today. So it just seems unfair. But Seth Weissman, you're in the business of real estate, and I would like to ask you, to begin with, we hear so much about how there's been trouble in commercial real estate. There are no houses for sale. So real estate seems to be in a troubled way, if talking with perhaps a much too grand generalization. But are you finding things of interest to buy?
So, we're mostly focused today on the credit side. And I think that's a reflection of we don't see opportunities on the equity side of the business to be as compelling. There's a variety of factors that come into play. One is, regulatory restrictions. It is very market specific. You're seeing what's happening in California with insurance, but you're seeing that play out in markets like Florida. You're seeing it here, where the cost of insurance on a per unit building basis has gone up 2 to 3 times in 5 years. So you're
Residential buildings.
residential buildings. So there's headwinds there. There's headwinds on construction costs. There's headwinds on just the regulatory, burdens, whether that's restrictions on your ability to raise rents to offset your expenses, or in the case of California, insurers fled the state because they couldn't adjust their prices to offset the risk.
Did you say flood the state or fled the state?
Fled.
Fled.
That's an important differentiation.
Big difference.
And now you're seeing the elected leadership revisit that policy, right? Similarly in New York, where they got rid of the 421A tax abatement because certain folks felt that it was too generous to developers, where developers argued that it was necessary to create housing. They let those benefits expire, and effectively there was no new construction for 2 years because developers couldn't make the math work. So it's all well and good to legislate, headlines and make things that sound good. But the practical effects have led to a dearth of housing and just general equity investment. You couple that with 11 or 12 rate hikes and much more compelling returns from a credit perspective. It's not a good recipe for commercial building values. And that's a reason that we've chosen to focus more of our business today on credit, is we're really earning equity level or equity-like returns with a credit level risk profile.
Can you give us an example or two?
Sure. So, right now in our portfolio, our average loan to value is about 60% of the asset price. Our average coupon is close to 12%. So, if I can earn a low double-digit return, or if our investors can earn a low double-digit return with a 40% margin of safety, that's very compelling. They're not going to go take equity risk to earn 15%. And be in a first dollar loss position. So you've seen a lot more people want to come into the market on the credit side and not necessarily take first loss risk. On top of that, asset specific, property type specific challenges, office being the most obvious one, that actually have sort of more of an existential question. But broadly, the cost of capital, part of the equation, the cost of construction, regulatory burdens, those have all combined to make being a commercial property investor quite challenging.
In terms of your focus on credit, part of the reason why the crisis in commercial real estate has been so slow to play out is that banks have been offering their borrowers extensions or modifications so that they don't crystallize losses. How are banks approaching their book of commercial real estate lending, and what kind of opportunities is that offering you, or is it kind of not offering you?
It's definitely situational. I think banks are trying to let the air out and slowly try and enhance the positions of their credit as much as possible. That might mean, requiring principal curtailments upon, loan maturity, or the addition of recourse or some type of component, because the underlying values, have significantly pulled in. And if you made Signature Bank is sort of the obvious example here, but they were making 65% loan to value loans on what was perceived to be very stable multifamily assets in New York City. You combined the regulatory changes in New York in 2019, where they restricted the ability to raise rents and basically destabilize or bring to market rent stabilized units. You combine that with 11 rate hikes, and that 60% loan to value all of a sudden became 100% loan to value. And those loans, as a result, plummeted in value. So it's not a matter of just, selling necessarily your asset. In some cases, the loans were, higher than the actual than the actual property value. You've seen that, with office as well. And if you're a bank, what do? Right? Do you just take the loss? You try and do that, but you also have to be mindful, I think, about your stock price and not having a run on the bank. You've seen what's happened with, obviously, it's not just Signature, it's First Republic, New York Community Bank. A lot of the regional banks are struggling with the same dynamic. It's just the asset value drop in such a short period of time didn't give them much ability to react.
In terms of banks, I had talked to a number of real estate investors, some we probably know in common. And exactly a year ago, they complained that while banks were selling some of their problem loans, they were selling at marks so high that it didn't make sense for a new investor to assume the kind of risk that commercial real estate is facing now. When banks go up to bid their kind of dud loans, are they offering high enough returns that you see a future, even given the risk that you still are experiencing today?
No, which is why I don't think there's been that much activity. And you're starting to see that change. The Signature Bank collapse forced the sort of, come to Jesus moment, if you will. But most banks are not facing that reality, or trying to, again, extend and pretend or wind down slowly. They don't want to take these assets back, right? I mean, my background as a developer and operator. When I started Urban Standard, it was as a developer and operator, and we have an equity and a debt business. So although we don't look for problem loans or problem properties, if there is a default, we are well positioned to take over, manage, and monetize a property. If you're a bank, most banks are not set up to do that and don't want to do that, right? They don't want to have that on their balance sheet and actually have the sort of quite heavy lift that goes into operating or renovating or developing a property. So they're very cautious about, do they foreclose versus give a lifeline, extend a loan, modify the loan. They again want to let the air out pretty slowly so that they don't create a sort of fundamental stability question for the bank.
Tell us about the nuts and bolts of running a building. It seems to me it would be a job. Of course, obviously, it depends on the size of the building. But how about giving me an example of something that might be in your portfolio that might default and that you might not be afraid of running? How big is it? How much manpower would it take to keep the lights on and the plumbing working and the tenants more or less happy?
So it depends on the type of building, the size, the asset type. Is it office? Is it multifamily? But I can give it a real example of a loan that we had that we originated in 2019. That was an office building loan, and it was a new office building. Our loan was to finance the completion of the building and to provide capital for leasing commissions and tenant improvement allowances. We originated that loan, as mentioned, in sort of March of 2019, with 12-month loan maturing in the spring of 2020. As you can imagine, that was not a great time for an office building loan to mature. And at the time, we sat down with that borrower, and part of the conversation, because they needed about $1 million to carry the building for a year. That's to cover taxes and insurance and all that stuff, which we were willing to provide. But we were willing to provide it in exchange for ownership in the building and certain controls, right? Because what you find yourself doing when you're taking over a building is, you're overseeing the day-to-day operations. Tenants have, issues with repairs and maintenance. You're doing collections. I mean, it's quite a, hands-on activity. We're set up to do it. We've probably done close to 50 projects on the equity side of our business. I think we still own maybe 25 buildings in the city, but that's not the case for most banks. And that's not the case even for many private credit or debt funds that are more financial players. They don't really want to get involved in that, and they wouldn't really know how to do it. We for better or worse done it for close to 15 years, and there are a lot of lessons learned over that time, but it does take a lot of work. You guys are tenants in this building. Most people understand on a day-to-day basis what can go well or not well, and unfortunately, when occupancy drops or your rate doubles, and now you had cash flow, but now you have all that cash flow is going to service debt. You don't necessarily have the ability to fund, the repairs and the maintenance.
I have noticed that.
You have noticed that.
For listeners who are not into the joke, our venerable building is in special servicing because its vacancy rate is now 30%.
Yeah. And in fairness to them, right?
Let's not be fair to these guys.
It's not unique to them, I should say, right? Mm-hmm. Like the demand for office has plummeted. This is a beautiful building, but it's not everyone's cup of tea. I think the buildings in the office space that are doing well are more of your sort of new Class A construction buildings. This is a storied building and has many wonderful attributes, but it's maybe not for everybody. But the challenge is, right, if to your point, if they have a 30% vacancy and they probably have a 20% fixed cost structure. All of a sudden, their cash flow and their capital stack, which was sized to probably 90% occupancy or 95% occupancy, they have a cash flow shortfall. Now, this is in special servicing, but then you have ongoing maintenance needs, incentive needs to offer to leasing, brokers, leasing commissions, tenant improvements. Where does that money come from? And this is why you've seen so many people, Blackstone and among others, just start handing the keys back on office buildings because their basis is just way too high.
So getting back to your loan, so you lent somebody money to with a loan that came due just as lockdown started. You offered to give them an extra $1 million to carry the building if you got some equity. Did that ploy turn out well? Did the borrower make whole on the loan?
So just for specific numbers, we had lent $8.5 million on a building that I think appraised for around $14 million as stabilized. Once COVID hit, we had some conversations with some leasing brokers and office investment sales brokers to start to triangulate value and understand where the market might be today, which it really was an educated guess. I don't think people know today, frankly, but they certainly didn't know in April 2020. We knew it was less, right, than the 14 million it previously appraised for. So we thought maybe it's 12, 11, 10. This borrower felt very strongly that it was worth 15 or go back to being 15. So they didn't choose the option where we offered to put up the $1 million. We had given them an alternative, which was to say, okay, well, pay us $2 million, $1 million to cover the taxes, insurance, and interest for that year, and $1 million to reduce the loan amount from $8.5 million to $7.5 million. And we will waive your extension fees. We'll actually lower your rate. We wanted to sort of land the plane as safely as possible and start de-risking. We manage money on behalf of major pension funds, asset managers, family offices, foundations. So this is slow, safe, and steady, down the fairway returns, right? We're trying to deliver 10 to 12% net per year to our investors. They're not looking to take a lot of risk. So when we see a situation that turned a little bit more turbulent, our immediate goal is, again, how do we sort of land the plane safely? I think similarly, if you're a bank, you have to assess your position and your risk profile and figure out how you unwind that position. And that was the approach we took. We ended up they ended up taking that option, the $2 million, and they paid us down to 7.5. At each extension, they had to reduce the principal balance of the loan further. So they ended up carrying that loan through November of 2023, I think it was. So basically almost 4 years. They paid us down at each extension. We'd been paid down to 5.2 million at the time they paid us off. They sold the building for I think 7.2 or 7.3 million. So obviously that's not a good result for them. It was very favorable to us. It was a good loan, but I think that speaks to, like, if you're a lender and you're a credit investor, how you have to manage through a turbulent situation. But we also were in a position where we could have very easily taken over and managed that building if need be, which gave us some, a different perspective.
So that borrower still had hope. And you pointed out that large landlords like Blackstone and Brookfield, when they saw the prices crash, they just handed the keys back to their lenders. When you're looking at borrowers in kind of struggling buildings or struggling asset classes like office, do they still have hope today? Are they still putting equity into buildings? Are they playing out just hoping that rates will go down and that things will get better at some point? What is the expectation?
It's a great question. I think that expectation depends on geography, asset type, their basis. If you have a lower basis in a property in a growing market, you might be more optimistic, right? Florida office, Miami office is probably looked at differently than Garment Center Class B and C office, right? Where the value might be the value of the land that it's sitting on. So it really depends on your cost basis, your capital stack, the asset type, and and what you think that the future holds. I think a lot of investors are having this question as they look at their portfolio and they assess, does it make sense to rip the Band-Aid off and just recover what we can recover, or put more money in? We do preferred equity and mezzanine financing as well. So where we will put in addition to a senior loan, we might write preferred equity check or a mezzanine loan. So we're working on one now. It's actually we don't actually do a lot of office buildings. 80% of our business is residential, but this is another office building where our preferred equity investment is financing the tenant improvements and leasing commissions associated with a 100,000 square foot office tenant that signed a lease. It's a corporate 500 tenant, big guarantee, and it's all sort of our money is funding good news money. It's going to stabilize the building further. It will bring occupancy into the mid 90s. So for them, it makes sense to continue to invest in the building, to borrow from us to get that tenant in place.
And what rate are they borrowing from you at?
It's a high teens rate.
Hey, Seth, I'm going to hold this up so that you and the listening audience can see it. Okay, everybody see it?
The listening audience can
Right.
see it.
This is the office CMB delinquency rate. CMBS is a commercial mortgage-backed securities. It's a mortgage on a building. And what is so interesting to me about it is that the delinquency rate, if this chart's correct, which I have no doubt it is higher than that posted during the so-called Great Recession of yesteryear. So how does that happen that at a time of low unemployment and general strong economy, we keep on hearing that this is the result?
It happens because of remote work and the demand for physical office space plummeting. If you have a 10,000 square foot office and you're now 3 days a week or what have you, you don't typically need 10,000 square feet anymore. You can probably make it work in half that space. So I think employers are reassessing, and I think you have a 7-day a week work policy here. Everyone has to be in the office 7 days. So, but if you're not on that and you're 3 days a week, you don't have the same need for space. And so the demand has plummeted, but the supply remains the same.
Is it as simple? Is there an interest rate aspect of this too, in that people took out these loans perhaps at very, very low rates, and after the rush of interest rates to catch up with the rate of inflation, they are shocked and can't perhaps meet the debt requirement?
That absolutely adds to it, and that's not unique to office. You see that with apartment buildings. We have in our portfolio some loans that are maturing now, and we're going from 3.5-4% interest rates to 6% or 6.5%. So you're seeing our rate almost double. And in our portfolio, which has been more about value add, renovating apartments, repositioning the buildings, so we're bringing rents up, right? So you got renovated an apartment that hasn't been renovated in 20 years, and instead of charging $3,000, you're charging $4,000, right? You can do that on a free market unit. You can't do that on a rent stabilized or controlled unit. But a lot of the value that we've created from putting in those improvements over the last couple of years, it's increased the top line cash flow, but all of a sudden my interest costs have doubled. So what does that do, right? That means that there's really not cash flow for distributions, or you need to rebalance your debt, and that puts a lot of, if you have a maturity coming up. So that combined with the sort of fundamental demand drivers that I'm talking about can be a knockout punch, frankly.
How are cities responding to this? And the reason I ask that is taxes on commercial real estate tend to be a big revenue source for a lot of cities. The revenue tends to come from an assessment of buildings. Valuations are down. Some building owners are now going dark, and they've just mailed back the keys to their banks, or they're not paying anything. So what's happening is cities are getting less money from buildings. What are they doing in terms of taxes, assessment, how they're going after landlords?
Sure. Some assessments are down. They're not down nearly enough to reflect the decline in the value of the buildings. I think you saw that I think it was the Securities and Exchange Commission last week or 2 weeks ago came out with specific concern for banks that have lent on rent stabilized buildings, and they're really focused on those values and what that means for the lenders and their balance sheets. But cities have taken a little bit of a mark, but not nearly enough to reflect the actual value, and that creates a further pinch point because your taxes, that cost has not been adjusted to reflect the reality of the value. And it's catching up with cities, because at some point people default. These buildings go back to the lenders or are sold at 50 cents on the dollar, and that establishes a real third-party mark. And sometimes, depending on the municipality, like that mechanism sets the assessment, right? It's one thing to say, okay, this building is worth $100 million just based on an appraisal or a valuation. That doesn't have the weight that an actual transaction between the two parties has.
Yeah. So capitalism is nothing if not adaptive and inventive. And Evan discovered something out here that I had never thought of for an alternative use for underpopulated office buildings. Evan, have you yourself thought about opening a vertical indoor farm on which you perhaps might grow kale or cucumbers?
Not personally. I can't say that I have.
But is that a thing from
I have seen this. I think also we were discussing that there was a building in Midtown and another one that I'm aware of where they're converting Class B office to self-storage. That's not great for
That's not going to contribute to the vibrancy of New York City nightlife.
Of life period. And so, but I think that speaks to like how dire things can be for certain types of office buildings that, storage is the best use. This sounds great, but I don't know how scalable vertical farming is.
How about
You can never have enough kale.
That is true.
how about the vertical cattle ranches?
My understanding is that the vacancy rate in U.S. office is 20%. So 1 out of every 5 offices or floors or however you want to count it is vacant. We have a number of buildings that are still churning because I think the typical office lease before everything kind of blew up was like 7 or 8 years. So we still have leases that were signed, in 2018 and 2019 that are coming up, and people are still shrinking their floor space. What is kind of the end game for all of these vacant office buildings, and what's going to happen to kind of like the people financing them?
Like many things, it comes down to what your basis is. We did a loan in Little Rock, Arkansas, financing a group that bought a note and foreclosed on the owner. They bought the note at a discount, foreclosed on the owner, and now took ownership at a new basis. That basis allows them a lot more flexibility in making capital investments into the property, the rates at which they can charge and attract tenants, right? Instead of trying to get $25, they bought it at I'm just using this as an example, but they can maybe charge $15 because they don't have the legacy cost basis that the previous owner did. So I think that will all over time work through the system. There is tremendous pain and people are losing a lot of money, and it's not just limited to 100% wipeout of the equity, right? The senior lender is often taking a hit. And many times the senior lender might have leverage on their loan, right? So thinking about a $100 million office building example, they borrowed $60 million. So the $40 million of equity is wiped out. But of that $60 million, there might be a mezzanine or B piece tranche, right? That's $40 to $60. And then the senior holder that's holding $0 to $40. So values have dropped 60%. Not only is the equity completely wiped out, but the mezzanine tranche is wiped out, and maybe even part of that senior is wiped out, right? If values have declined beyond 60%. That's really unique to office, that kind of value decline. I mean, I don't think we've seen that in the multifamily space because there's such a tremendous demand for housing. So the operating fundamentals are pretty strong, right, in terms of rents. And
how about other kinds of commercial property, such as industrial buildings?
Industrial is pretty strong. I think it depends on the type and the location. We are, especially when you think about last mile and cold storage and even data center throw in there. I mean, there are significant demand drivers for industrial, but it doesn't. It helps to have those fundamentals be strong, but to your point, if your interest rate has gone up by 2 times, that still can cause a lot of pain.
The data center business, we've taken a recent interest, including in this current issue, in the economics of data centers and the disruptability of those economics by leapfrogging technology. So you wake up in the morning and somebody you haven't heard of has destroyed the arithmetic of data centers as we knew them the day before. So what do you know about data centers? The supply would seem to be growing rather faster than the projected demand anyway. And now we have this disruption from, of all places, not all places, come and think of it, it's perfect logic. We have a technological disruption coming on top of the evident arc of overbuilding. So what's going to happen there?
So we don't lend on data centers, so I can't really speak to the specifics of that part of the market. But you're absolutely right that things overnight. We talked about the the busy first week that Trump had, and all the changes that came out of that first week. You referenced coming out of China, the changes in AI. Yeah, it's a little scary to have such a quick fundamental shift that undermines your entire underwriting investment thesis. But you could say the same from office, right? You think of the big real estate families in New York; these were office real estate families, right? Think about like families like the Dursts and S.L. Green and all those groups. Well, Cohn brothers, right? Those went to zero, and I don't think people would have thought, oh, office is going to go away. So I think every asset type has that exposure. We lend and focus on residential because there is such a demand-supply mismatch, and ultimately people do need to live somewhere.
But not bots.
But not bots.
In terms of the opportunities you're finding, so in CLOs right now, the distress ratio is actually the highest it's ever been. And this, again, includes the great financial crisis. And peering down to the numbers, office is, of course, leading that. It's the worst asset class. But the second worst one is actually multifamily, the apartments that have good fundamentals. And at least as far as Jim and I have been able to figure out, it's not a problem with demand. It's not a problem with the asset class per itself. It's just that in 2020, 2021, and early 2022, a lot of people finance these buildings at very, very low rates that at very, very thin margins of safety. And as rates rose, a lot of these buildings just became underwater. What kind of opportunities are you finding just from kind of the mistakes of yesteryear, and how much more has it to play out in multifamily?
If rates don't go down, there's a lot more opportunity because to your point, the fundamentals of the capital structure have shifted, right? So, and you went from a 4 cap environment to a 6 cap environment. Well, that's a decline in value of 50%, right? And so that means your equity is pretty much wiped out, right? Even if you were borrowing conservatively. So what do you do if you own those buildings? You either say, I'm going to hand the keys back, or I'm going to default, or I'm going to try and bring in rescue capital. We have conversations where we bring in preferred equity to right size the senior loan and give effectively a hope certificate to the current or previous owner to say, well, if rates do come down and you're able to go borrow at 4.5% or 5% in 2 to 3 years and values recover, there might be some ability to participate in that, but there's no guarantee. And that's really the only way to sort of navigate those waters is to say, okay, I'm going to right size my loan. And sometimes that's LPs, going to your LPs as a general partner and saying, I think the long-term thesis is still there. The fundamentals, to your point, are solid in terms of rents and occupancy, but we have to weather this storm. But as we face a higher rates for longer environment that we're in, that gets harder to do.
This crisis has been playing out at kind of a glacial pace. The Fed started raising rates in very early 2022. Valuations and cap rates quickly corrected, and we've not seen, a hard crisis where everybody, has problems at once. It's been playing out very slowly. Do you think that it's going to continue just slowly grinding out, or do you think that at some point it's going to accelerate? And if so, what does that?
I think it still continues to be maybe not glacial, but slow, because I think the alignment of interest and the motivations from the different players actually are sort of aligned. The banks can't take those write-downs immediately because those banks will collapse. And the Fed and the regulators, I think, are being mindful of that. They don't want to have runs on all these regional banks that typically hold that paper, or in some cases, some of the publicly traded securities. So if you're an underwriter or you're an asset manager at ABC Regional Bank, you've got to be sort of careful what you ask for, because they're going to look at your portfolio and they're going to mark it to the current value, and then you're going to say, okay, well now, I have to report this full loss, and your bank's upside down, and you start to see it spiral, a la Signature Bank, a la First Republic, and other examples. So I think that is why you haven't seen that Band-Aid be ripped off. There's a lot more willingness to work with your borrower through the turbulence. Again, it depends on what your portfolio looks like and how concentrated you are. If you're, not to pick on Signature Bank, but if you're Signature Bank or New York Community Bank or any of these banks that have a heavy concentration of exposure, it's very hard to overcome. If you have a diversified loan book, you hedged your interest rate risk. I think the biggest issue with First Republic is they didn't hedge their interest rate risk. right? So they weren't able to offset the other losses, but that effectively incentivizes banks to work with their clients versus force a default in a foreclosure. But I don't think the fundamentals have changed. Rates have not gone down in terms of the actual cost of borrowing for many commercial multifamily assets. So it's going to continue to play out.
When does a thoughtful forbearance end and fraud begin in bank regulation?
It's a great question. I think it's a great question, but a tough question to answer because I don't. Is it just sort of the extend and pretend make believe? Is that fraud? I don't know, but I think there's a sort of a systemic question to ask, and each bank again has to sort of look at their own portfolio and their construction of that portfolio and determine whether or not they think that there's a strong argument that values recover and that there's debt service coverage and all those things. But it's fair. It's a very fair question to ask.
I wonder where the Trump administration out loud thinking about abolishing the FDIC. I wonder how this would play into the confidence question.
That's a good question. In terms of the Trump administration, because we started this conversation talking about the president, he's just offered federal workers a buyout. I think they get 8 or 9 months of income if they choose to take the buyout now. I believe that the government has a lot of offices that it doesn't fully occupy. Is there a risk that the Trump administration tries to, through its DOGE operations, right-size its real estate footprint? And if so, what does that kind of mean for everybody?
Well, I think it makes the office market worse than it is. I don't know how much thought there is, to the effect of trying to right-size. It probably is the right thing over the long haul. But again, it's only going to make those markets where there's a heavy government concentration of demand, worse. DC is already, the office market there is quite soft, especially with very favorable sort of remote work, terms for government employees. It's interesting about the sort of consumer deposits and the FDIC. One heavy discussion point has been the role of private credit in the capital markets. And I think there's some folks who feel that it is unregulated, and you've seen Jamie Dimon sort of frankly speak out of both sides of his mouth. Like on the one hand, he's pushing into private credit. On the other hand, he expresses a lot of concern about the various players in it. But you've heard members of the Fed talk about that actually private credit with a more sophisticated investor base, whether it's institutional investors or high net worth individuals, family offices, what have you, is more of the natural place for loans on transitional assets to live versus banks with consumer deposits. I think that makes sense. I mean, we have a very sophisticated institutional investor base. I think we're in a good position to navigate risk. We're not lending out consumer deposits from individuals. So I think that's the right alignment.
And just at least one last question for me: are you bullish on your business? And if you are, is that because you're bullish on real estate fundamentals or just the opportunities you're finding?
I'm very bullish on our business, and it's because of the opportunities that we're finding. And I think, private credit will continue to gain market share from traditional lenders, partially because there is a natural gravitation toward, a different investor base making loans on transitional assets. But you're seeing banks, that are really not able to provide sort of bespoke or flexible capital structures that lends itself to the private credit market and lends itself to, I think, groups that have the experience as owner operators and developers. The biggest thing that we have seen and continue to see is that banks are really struggling to maintain deposits, especially regional banks, because one, there are alternative options for current income. Is it money markets? Is it is it treasuries, what have you? So a lot of folks have moved their money out of your traditional regional bank, and if they do have deposits, they're probably not going to keep them at the regional bank. They're going to keep them at a bigger bank because of all the perceived or real concerns about the safety of those deposits. So what we've seen in response is that banks, when they're issuing loans, are going to developers and saying, you want that $50 million loan, you need to have a 10 or even 20 the highest I've seen is 30% depository relationship with the bank. So you get on a loan for $50 million, you have to have $10 million in deposits with the bank. Well, most developers don't have that liquidity. If they do, or they can get their investors to put up that liquidity, that has a significant drag on their equity returns, so they're reluctant to do it. So it's put us in a good position because we're not a depository institution. We don't hold deposits, and yes, our cost of capital is higher, right? Our typical coupon as reference is at the moment sort of 11-12%. We're not requiring you to park money earning 2%. I think there's a greater certainty that we will close and perform. People are very comfortable with the certainty of execution that not only we provide, but I think generally private credit can provide. So those are very sort of positive tailwinds for private credit generally, and for groups that have been doing it for a while. I mean, we started doing this in 2016. And there's a lot of new entrants to the space, a lot of sort of quote unquote tourists into the private credit space. It's to our benefit for having
like the Substack people.
Yeah.
Annoying, aren't they?
Exactly. Well, maybe you'll get a seat at the new. I saw Trump. They're going to have a new media seat.
Yeah, everything's different down there.
Do you qualify for a new media seat, Jim?
Well, we are a 42-year-old new medium. I think we would be regarded as a crusty and legacy. Seth Weissman, thank you for coming, for making the hall from the 14th floor to the 24th floor on a different elevator bank.
Yeah.
Here at 233 Broadway. What a pleasure.
Thank you for having me. It's always a pleasure speaking with you guys.
And ladies and gentlemen, thank you for listening in. Until next time, this is Jim Grant on behalf of Grant's Interest Rate Observer and Current Yield.